Working capital is an important concept. In its most general form, it is the excess of current assets over current liabilities. That is, take current assets, subtract current liabilities, and that value, that amount, represents what's called working capital, or, more technically, net working capital. It's an important measure of liquidity. Obviously, if current liabilities, for the most part, represent amounts you're going to have to pay, obligations you're going to have to satisfy within 1 year, and current assets represent the amounts available to currently to pay those obligations, then you need to have at least as much in current assets as you have current liabilities. And the truth is that may be not nearly enough, especially, for instance, let's say that most of your current liabilities represent short-term debt, maybe salaries and wages payable or accounts payable that have to be satisfied within 30 to 60 days. Whereas, let's say a big chunk of your current assets represent inventories, which may take weeks, months to sell, and then if you sell them on account, now you've got to wait for your customers to pay. And so that will be something. It's really not possible to overgeneralize. Well, it's not good to overgeneralize, and to say, well, as long as a company has like twice as much current assets as current liabilities, it's okay. For some companies that may be very excessive, and for some it may be not nearly enough. But it's important, at least here, to understand as we look at current assets and current liabilities, that relationship between those two is a really important one that speaks to the company's ability to pay its bills on time. That is, and that's how we've defined liquidity. Long-term liabilities are obligations whose settlement dates extend beyond 1 year or one operating cycle, again, whichever is longer. Examples are bonds payable, long-term notes payable, amounts of obligations, what we'd call present value of lease obligations, pension obligations, and these things can be very sizable. But again, this is a category that we will look at in a lot more detail in the second part of intermediate. At this point, we need to be aware of the types of, how to define long-term liabilities, what it is that distinguishes long-term from short-term liabilities, and of course what the players are, or examples of those are, that we may see. Even if we look at a company's financial statements, you want to be able to look at a company's financial statements, and right now, and understand them, even if you don't know everything you will know or will need to know about these different line items, like what bonds payable represent, you know that they're long-term debt. Okay, so we want to at least have that understanding of these things, so that we know, at least at this point, how to categorize them. So when we get there and we address those in more detail, it's not going to be like a brand new surprise to us. It's going to be adding on to something maybe we're already somewhat comfortable with and aware of. Generally, the disclosure required for long-term liabilities are extensive, because very often you have some complex debt covenants included to protect the lenders. It may be restrictions on dividends. It may be restrictions on a firm's investments. It may be specific collateral that is designated as specific security on that debt. And so one of the major sets of or categories of footnote disclosures at the end of the financial statements is going to explain what the company's obligations are. And frankly, most people would have no clue as to what all that is, but financial analysts will understand and be able to make more sense of that. Long-term liabilities that mature within the current operating cycle are classified as current liabilities if their liquidation will require the use of current assets. Again, this is one of those things. Let's say you got long-term debt, but in fact the company is intending to liquidate that debt in the next within the next year or operating cycle, and has the ability to do that. If that's the case, then that really would be classified as a current liability. We've also talked about the current portion of long-term debt. Most corporate bonds these days, say a 10-year bonds, let's say it's $10 million. The company's generally not going to pay back $10 million at one time at the end of 10 years. It's going to repay that loan in installments, $1 million a year plus interest, for instance. So every year there is an installment of that debt that's going to come due, and so it's actually going to represent a current liability, specifically what's called current portion of long-term debt. Long-term liabilities generally fall into one of three of these three following categories, or these following categories: obligations arising from specific financing situations, such as the issuance of bonds, long-term lease obligations, and long-term notes payable. We call these discretionary financing because the company has consciously gone out and signed on the dotted line. They borrowed this money. They've issued these bonds. They didn't wake up one day and surprise they owed this money. The second one, though, are obligations arising from the ordinary operations of the company, such as pension obligations and deferred income tax liabilities. And these are regarded as spontaneous financing. In these situations, the company enters into a commitment, say, with its employees, and so that commitment for those employees eligible for the plan, as they provide service, then the companies, then their benefits in the pension program increase, and the company's obligations increase as well. And then finally, obligations that depend on the occurrence or non-occurrence of one or more future events to confirm the amount that's payable, the date that's payable, or even if there is any liability, such as product warranties and other types of contingencies. We will throw into the category of this return policies. When you buy things at Walmart, you know you can return them. How do they figure out? How do they know at the end of the year how many, or does it matter whether or not how many people are going to return products that were bought prior to year end? Well, I'll give you a hint, it does matter. But once again, we go based on past experience, and we'll make estimates of returns so that we properly record the expense associated with those returns in the periods when we record the revenues. But this falls into a broad category of contingent liabilities. Now finally, owner's equity. The owner's equity section of the balance sheet includes information related to common stock, or sometimes called capital stock, additional paid-in capital, and retained earnings. Take care when preparing the owner's equity section, because a number of restrictions imposed by the state corporation laws, liability agreements, and voluntary actions of the board of directors can complicate things. And so we'll deal with those, for instance, restricted stock, or limitations on, let's say, retained earnings, the amount that can be distributed as dividends. We might call appropriated retained earnings, but we'll deal with those even next semester. So right now, just we've covered the basic components of owner's equity, and you should know that it represents the residual claim on the assets of the firm. And for now, that's probably enough. Now, as we wrap this particular little section on the balance sheet classifications, we should recognize that when you look at a balance sheet, you're generally going to find that the presentation is in one of two forms. The account form of the classified balance sheet lists assets by sections on the left side. Okay, I guess from your point of view, let's see, here's the left side, okay? And then it will list liabilities and equity here. So sort of a side-by-side presentation, very much in the form of the spreadsheet. Whether it's the bug person problem or the gift shop or Wainwright, whatever it might be. Whenever you have a balance sheet that's set up with assets over here and then liabilities and equity, that's what's called the account form. Just think of it as looking like a T account of sorts. And then there's the report form that certainly I think is more commonly seen in financial reporting in the corporate 10K. And that's the one really where you see things listed vertically, assets and liabilities and equity below it. By the way, it's not a coincidence that liabilities are listed before equity, because liabilities represent a prior claim on assets that is before equity. This section on financial statement footnotes I thought was helpful, but it wasn't from your textbook. It's actually from Accounting Coach or accountingtools.com, one of those. There are a number of good resources on the internet and lots of YouTube videos that can get, if you want to understand the accounting cycle and get a different take on it or different perspective, I highly recommend just spending a few minutes and find some good resources there. So this is a summary of, and a fairly extensive one, of what you would find and the purpose that's served by in a set of footnotes or notes to financial statements, and what purpose the notes to financial statements serve. Financial statement footnotes are explanatory and supplemental notes that accompany the financial statements issued by a company. The exact nature of the footnotes varies depending on the financial framework used. That is, whether you're following GAAP or IFRS, the International Financial Reporting Standards. We're not concerned about IFRS yet, but we will be in the future. We'll spend some time talking about primarily the differences between GAAP and IFRS. Financial statement footnotes are an integral part. That means that they have to be presented. It's not just a nice thing to have, a nice addition, but they are a necessary and required part. So you must issue them to users along with the financial statements. They're extremely valuable to the financial analyst, who can really make more sense of them than the layperson can. They can discern from the footnotes how various accounting policies used by the company are actually affecting reported results and financial position. There is a term used in financial analysis called quality of earnings. And what that means is, essentially, you may have two companies that report essentially the same earnings, and even earnings per share, let's assume. But you've got one maybe that has a lower quality of earnings than the other one, because maybe it has chosen certain, made certain estimates, or chosen certain methods to use with regard to valuing assets or valuing inventory, for instance, certain assumptions that were made that would, let's say, tend to inflate its earnings. And so its earnings, if they are in fact somewhat inflated by these legitimate choices now, they're not, companies have choices even though they're not necessarily doing something illegal, but still an analyst will be able to tell by the choices the company's made whether in fact this earnings amount is a more conservative or in fact a bit inflated. If you've hired an auditor to conduct an audit of your financial statements, that auditor will conduct just as thorough an investigation of the footnotes of the financial statements as of the financial statements, and will base his or her opinion of the financial statements partially on the information contained within the footnotes. An even more extensive set of footnotes are required by the SEC of any publicly held company when they issue their annual financial statements in the Form 10-K and quarterly financial statements in the Form 10-Q. All publicly traded companies are subject to SEC regulations and are required to provide this information to the SEC, and therefore it's publicly available to really just anybody. The number of possible footnote disclosures is very voluminous, and so this following list touches upon the more common footnotes, the biggies, but it's not an exhaustive listing. If your company is a specialized in the specialized industry like airlines or agriculture or mining operations or software development, and especially if it's in a financial company, insurance company, mutual funds, banking, those sorts of things, there may be a number of additional disclosures. As a matter of fact, financial companies have more unusual financial statements even. We very broadly categorize financial statements between non-financial companies and financial companies. And so we deal primarily with non-financial companies. That is, like Home Depot, Lowe's, Walmart, Microsoft, on down the line, as opposed to, as I mentioned, banks, credit unions, brokerage companies, mutual funds, and investment companies, insurance, and so on. Well, let's look at these major types of footnotes. Accounting policies. The very first section of a set of footnotes is going to describe the significant principles followed in producing the results that you find in the income statement, balance sheet, statement of cash flows. Number two would be accounting changes. If the company is engaged in any changes in accounting methods that it's followed during the period. For instance, if it changed from FIFO to LIFO, inventory cost flow, it would need to explain that and show the effects of those changes More about those things later on. Any related parties that it has dealt with, contingencies and commitments. Again, these are generally liabilities that are contingent liabilities, meaning they're not full-fledged liabilities yet, but they will become liabilities should certain events transpire. Risks and uncertainties, that's a big section these days where the management has to outline really the major risks that the company faces, whether it has to do with a very short product life cycle, or whether it has to do with competition from abroad or foreign currency translation issues, or maybe the potential for certain laws to change. Just a number of things are going to be listed there. Non-monetary transactions the company is engaged in. Subsequent events, these are events that have occurred after the end of the fiscal year, but before the financial statements are issued. And so I may say more about that in class, but the company would need to identify the nature of any major subsequent events and estimate as best they can what the financial effect on the firm is going to be. Business combinations that the company is engaged in during the period, where it's combined with through mergers or acquisitions with other companies. Fair value, to disclose the amount of fair value measurements the company has used. As I mentioned earlier, this is really an increasingly important theme in accounting these days, is the desire to show more relevant market-based values, primarily for assets, but as we'll see also for certain liabilities. Cash, receivables, investments and inventories. In other words, to look through the specific accounts and provide information that will help the users of financial statements to understand certain policies or certain conditions associated, certain important information that they might use in order to better understand what those values in the financial statements actually mean. Fixed assets, goodwill and intangibles, liabilities, pension plans to show the company's pension obligations during the period, describe its investment policies for pension funds. Any leases, a lease simply represents a long-term rental arrangement. And so the terms of the leases, some leases based on their characteristics may show up as liabilities on the balance sheet. Some may not. And so this section here would describe those arrangements that are classified as leases. Stockholders' equity, segment data. It's probably important to understand not just that Walmart, had X amount of revenues over its entire operation this year. It had X amount of profit and has X amount of assets and so on. But Walmart is actually a global company, and so its operations are actually quite diverse. So you've got North America, of course, Europe, Africa, Asia, so you would really, in order to understand and be able to evaluate performance and position, this segment data is going to show information for those key segments. They may be geographical. They may be based on simply you may have a company that is actually operating in separate industries, and so they provide divisional information. Revenue recognition, the company's revenue recognition policies. Usually that's going to be pretty straightforward, but again, you may have installment sales. It's where, or maybe some long-term production, like construction, where you've actually got revenue recognized by what's called the percentage of completion method. So this is where you would describe revenue recognition policies. The sheer size of the footnotes can really overshadow the financial statements themselves. Certainly the financial statements are going to be a few pages. The footnotes can be, if the financial statements are spread over maybe 4 or 5 pages, you'll probably find the footnotes that spread over 20 to 30 pages. So they're going to be quite voluminous.